Okay, so this little quiz is very important money and risk management illustration, this actually, and it was actually done at a university. You have £10,000 to trade with, and you've got 100 trials in a game in which you can win 60% of the time. So it's a bit like trading. You've got £10,000, you've got 100 trials. Well, actually, in trading, you've got an unlimited number of trials until you drop dead or you lose money. You run out of money, in which you've got a 60% chance of winning. So let's say you've got a trading system which works 6 times out of 10. Now, if you win the amount that you bet. If you lose the amount that you bet. So what happens is, if you win, you get double your money. So it's a bit like finding one of those small cap stocks which has just doubled in value. If you lose the amount of money that you bet. So it's a bit like finding one of those fantastic .com stocks, which goes all the way to zero. Out of 40 PhDs who were giving this test, only 2 made money. Even though 6 times out of 10, they could win. Despite the fact they had a system which 60% of the time would have given them a positive return, they still managed to lose money. So there you go. That's enough for people who think, oh yeah, well great, you've got a system which wins more often than not, that's the key. Well, no, it's not. Why would only 40 make money? I mean, this is like trading. £10,000, 100 trials, 60%. There's your returns. It's a stylized, simplistic example of trading. Now, it's not because of the stocks they picked, because, like I said, if you picked the right stock and 6 times out of 10 you did, you won double your money. So it wasn't to do with all the magazines and, oh yeah, wow, well, the ones who won must have got into Microsoft at the right time. That isn't it. So what is it? How come only 2 made money? How come the vast majority lost money? How come the vast majority of private investors lose money? I'm about to tell you. Now, if I was American, at this point I would say, hey, and it's the greatest, biggest secret in the history of trading. Well, guess what? I'm not American, so I can't say that. But instead, I can tell you that actually it is pretty significant. The reason only 2 made money is because of the amount of money they bet on a trade. They didn't obviously put the whole 10,000 in, because they'd lose 40% lose the money straight away. It was to do with the amount of money you put. So let's say you risked £1,000 in each round and lost 3 times in a row. You might reason, I'm due for a win. So next, you bet £3,000 to break even. If you lose again, and it can happen, it's only 4 times, you've only got £4,000 left. Your chances of making money are now slim, because you have to make 150% to get back to £10,000. 150% to get back £10,000. Well, that's not likely. I'll tell you why. George Soros is very happy if he makes more than 25% in a year. You make 150%, okay, that's a little bit extraordinary. I don't think that's right. Do you see? If you risked £1,000 in each round and lost 3 times in a row, you may reason, I'm due for a win. It just is ridiculous. Due for a win? Now, I've done mathematics, and a lot of it, and there is no statistical theory which says to me, I'm due for a win, when each new trial of the game is independent of the previous one. How can you be due for a win? You might have a streak of bad luck, but you're not due for a win. In the same way, just because you throw 10 tails doesn't mean you're due for a heads. But that's what private investors do. They do not understand odds. Some argue they have a desire to fail. The PhDs risk too much money. For whatever reason, they might have got a bit greedy. That's what happens. What about websites and software? I'm always asked about, what about which ones do you particularly like? Have a look at these 3. They're ones that I haven't mentioned too often, but they're interesting. And the only thing about websites is, between the time I mention these, God knows what happens in the .com world. They could all have gone bust and closed down. They actually won't have done, but you never know. So I thought I'd mention those websites. Let me show you a bit more of money management. Drawdown. If all your money in your portfolio goes down 5%. Now remember, if you're doing a trade where you're saying, I'm not going to risk more than 1% on any one trade, then for it to go down 5%, you'd have to make 5 consecutive losing trades. 5 consecutive losing trades. That could happen. You'd only be down 5%. Remember the PhDs? They'd probably be out, lose all their money in 5 trades. You'd only be down 5%. A professional trader would only be down 5%. In order to get back to where you were with the rest of the money that you have, So let's say you went from 100 to 95. With £95, you'd have to get a 5.3% return to get £95 back to £100. 5.3% return, that's doable. If you were down 10%, you'd have to get 11.1% return. Okay, looks a bit tighter because for some people on a low risk portfolio, that's their whole year's result. If you're down only 15%, you've got to get a whopping 17.6%. Once you're down 20% on your whole portfolio, you need to beat Warren Buffett's long-term average. By the time you're down 25%, just only a quarter of your portfolio, it's not much. You need something which is probably going to take you a couple of very good years. And you could be down 25% in what, 5 trades? It'll take you 2 years. 5 trades would take you 2 years to recover if you're down 25%. Do you know what private investors do? The good ones, they make sure they never get down to this bit. Oh, and don't even let me tell you what happens when you get down at 50%. They make sure that they stop it here. How do they stop it there? Simple. They make sure that the most they risk on any one trade is limited to 1%. That way, a whole string of losing trades and they're still not out. Oh, by the way, if a stock drops 90%, is it likely to halve in price? Would you buy it? If a stock drops 90%, would you buy it? You might think, oh yeah, it's dropped 90%. How likely is a stock, let me ask you another question then. How likely is a stock that has dropped 90% likely to drop to 95%? You're going to say, oh, well, quite likely. If it's gone all the way down 5, down 10, down 20, down 30, down 40, and so forth until it was down 90%, it's pretty likely it can easily go to 95%. I've got news for you, and again, it's money management. If a stock drops 90% and halves in price, then it's down 95%. So here you might have said, oh, no, I'd buy it. Here, what you're saying is, oh, no, I'd sell it. And that's because you don't understand the math. I'll give you an example. If a stock drops 90%, so it goes from 100 pence to 10 pence, and then it halves to 5 pence, well, that's a 95% drop. 10 pence was a 90% drop. 5 pence is a 95% drop. If something can drop 90%, can it drop 95%? Yes. If something's dropped 90%, is it likely to halve in price? Yes. I thought I'd mention that because there's a lot of people who look for these recovery stocks and get their fingers burnt and they don't understand why. The other thing to remember on a risk management perspective is that the mountains are steeper than the valleys. In other words, the valleys can go on, the downtrends can go on for quite a long time, but the mountains can be quite short and sharp upwards, and that's it. But the valleys, don't expect the same on the downside as you got on the upside. That's the lesson of that. Okay. How important is money management then? We've learnt a lot about money management. I've given you some very, very important and incredibly top secret formulas. But how important is money management? Well, research shows money management explains 91.5% of the returns earned by 82 large pension plans over a 10-year period. It all had to do with how much money they put into funds and how they allocate their assets. Didn't have to do with stock picking. Decisions relating to time and investment decisions accounted for less than 10% of return. The discipline, as Pat Arbor put it, former chairman of the Chicago Board of Trade, the discipline not to trade, that's the big one. A lot of people don't realize that. There are times when the market is terribly volatile and makes no sense and you should not be trading. I have seen people place a trade out of boredom. I say, take it easy, take a walk, go for a coffee. That's a very important money management, risk management lesson. It's a qualitative one. It's not, oh, you must only invest X percent. What it's telling you is, next time you're bored, remember it's about money management. Okay, I want to talk a bit about trade planning. I do talk about this in one of the later CDs later on in some detail as well, but I do want to talk about it very briefly now. Because I think it is important in money and risk management as well. Why bother? Why bother with trade planning? Well, as one trader put it to me, if you go into a trade with a wishy-washy attitude, you're going to be in wishy-washy in execution. You need a plan so you know where you stand. Benefits of planning are certainty, strategic response to the future. So that's what is certainty. Certainty is where you have got a plan for the future, and if this happens, I'm going to do this. If this happens, I'll do this. And if this happens, I'll do this. You have got an idea of where you're going to be, what you're going to do in each idea. Control over trading and emotions. You are on top of your trading and on top of your emotions. There's also the avoidance of psychological comfort. What you want to avoid, very much above all else, is feeling, it's okay, I'm just going to take this trade, I'm comfortable with it, and so forth. That is just pure bad trading. When you plan, you know what targets you're looking for, what exits you're looking for, not just, I'll just take it as it comes. What's in a good plan? Well, you've got to be clear about entry and exit. You've got to write it down, because believe me, if you don't write it down, I know what's going to happen. You're going to forget and do something quite different in reality. And it might look like this. I mean, this is just an example, but you might write down your expectations. Buy if the price makes a new high. PE ratio is below the sector average. Earnings rise over the past 3 years. Uptrend has been in place for 6 months. Average broker recommendation is buy. Sector trends are upwards. Those are my triggers as to why I want to buy. This is part of the plan. This is how you write down your trading plan. Exit if the price breaks the trailing stop or if the fundamentals change. That's your target. Yeah? Once you've got a plan, as they would say on the A-team, you've got to stick to the plan. Self-discipline, and remember, the mindset of a professional trader, somebody as legendary as Martin Burton of Monument Derivatives, is a loss is a success if it is what you plan to do. You should be shocked how many professionals take the time to set a game plan and then do not follow it. That is just stupid, says legendary trader John Najarian. I know people probably won't take or heed my advice, but it is so important. What about exiting and handling losses? Well, I'll deal with this briefly in the next chapter.